Thank you all for coming today. And this is a panel on alternative investing, the cure for stock and bond blues with a question mark, because it may be, it may not be. First of all, welcome to LA. And if you noticed outside today, that drizzle is what passes for a hurricane here. So you can all go back to your homes and tell your friends you were in a hurricane in LA. I'm going to introduce the panel, and then we're going to get into a good discussion, I think, about what alternative investing means. Let me throw out a number first, or just ask for a show of hands. So over the last 10 years, the S&P 500 has returned an average annual return of 6.9% over the last 10 years. How many people think over the next 10 years the S&P will beat that 6.9? Okay. The Barclays Aggregate Bond Index returned 5% a year over the last 10 years. How many people think we'll beat that in the next 10 years? Okay. That's probably why you're here. I think that's one of the most prevalent thoughts on Wall Street today and Main Street is that returns on equities, plain vanilla bonds, will be very poor over the next 5 to 10 years. What scares me about that is that so many people have that view that the shock may be in 10 years we're talking about how well the S&P did. But that is the conventional wisdom, and we know the crowd sometimes does get it right. Let me introduce the panel. On my far left is Scott Sperling, co-president of Thomas Lee Partners. We've got Carrie Tomei, director of investments for the Wisconsin Alumni Research Foundation. John Rotolo, chief investment officer of Wood Creek Capital and Management. Here is Jody Gunsberg, global head of commodities and real assets at S&P Dow Jones Indices. And finally, Jonathan Grunzweig, executive director and global head of special situations at Colony Capital, who's local. So I want to start off sort of with dessert rather than the meat and potatoes. And I'd like to ask each of our panelists to briefly name the 1 or 2 alternative sectors that they think have the best return prospects over the next 3 to 5 years, and why that be. So let me start with John.
Thanks, Tom. Good morning. We are real estate focused, so I don't want to be at risk of only talking up my own book. That was the instruction. Shockingly, we're in favor of a heavy allocation to alternatives. And that's not merely driven by the data points Tom was summarizing, but a view that all of relative return, all of it comes from asset allocation. And you see extreme examples like Yale famously allocating, I believe, 78% in recent years to alternatives and performing well above their peers and their benchmark. That's not for everybody. The strategy has to be tailored to an investor's objectives. And nowhere is this more true, I think, than real estate, because we know with an infinite life asset class that real estate over time, with sufficient time, is a very durable investment and investable asset class. However, it is debt that is not very forgiving. When we look at the investable real estate world, and let's focus on the US for the moment, investors typically start with REITs. Albeit liquid, listed REITs are considered well within the alternative investment space. We think there's very much a place for REITs, but I wanted to mention a few words of caution. Firstly, the equity indices broadly have shown a much greater correlation to US NCREIF and other REIT return measures than historically has been the case. And that means that investors seeking diversification need to consider access to different kinds of real estate, even if it is more difficult for them to acquire at scale. Why is that? I think a couple of trends that are important for investors to bear in mind when you consider the REIT market. One is that the indices and ETFs have become increasingly large owners of what is a sub $1 trillion investable asset class in US REITs. And we think that is going to continue because of the second trend or phenomenon, specifically that real estate historically has been classified under the financial industrial code and blended in with those other businesses. It's getting its own industry code, and that will have, we think, an increase in the portion of REITs that are owned by these indices, and that will in turn limit the ability for investors to achieve diversification. So where to go in real estate? Here, having to talk my own book, we think credit is extremely compelling. In equity real estate, you have to assure long duration. Tom indicated 3 to 5 years. We're selectively bullish in some spaces in the US, specifically light industrial is a space that we've had great success in. Why? Because as consumers, perhaps you've experienced yourself, the Amazon Prime phenomenon of next day delivery is changing the expectation of how individuals and consumers will acquire their goods. And as a consequence, other purveyors of goods need to establish enormously greater amounts of distribution centers than has been their practice historically. We also like the single family for rent asset class, sort of a new asset class. There are some listed REITs through which investors can play that, and we think they're very attractively valued. On the credit side, I would specifically focus on the trend that I'm hearing in many of the panels this week, that the dislocation from the retreat of banks and other conventional lenders has opened up opportunity for private managers to fill that void at attractive returns. We're getting mid-teen returns over a fairly short duration, so less interest rate exposure, in these kinds of strategies in US and international commercial real estate. And we think that's more attractive, especially on a risk-adjusted basis, than what real estate equity will tend to offer, especially over that time horizon. And there's other places in structured credit outside of real estate, in particular CLO equity, that we find to deliver some of the most attractive risk-adjusted returns in any fixed income product. I think those would be some of my highlights, Tom.
Okay. Jody, I know you can't talk about favorites necessarily for S&P, but I wonder if you could talk about your views on where we are in the commodity cycle. We've obviously had a rally this year. Things have come up from the lows. I was at a panel yesterday on energy, and I couldn't hardly believe how bearish the managers on stage were. I mean, one of them ended it by saying he basically would short every public equity and bond of energy companies because of the shakeout he thinks is ahead. Will this commodity rally stick, or is this just something that's a dead cat bounce and it's over?
The way that we look at where we are in the big picture is we say commodities and stocks and bonds all move in a cycle. Typically, the stocks lead the cycle. Commodities are more on the cycle, and the bonds are a little bit behind the cycle. And we've now seen 8 years straight of equity outperformance over commodities. And this is the longest in history with data that we have since 1970. And the only time that came even close was the period of 1980 to 1986 when the commodities started outperforming equities. They returned over 300% through 1990. Now, if we look at that and we say, okay, maybe the future behaves like the past, then we would say it might be time to switch to commodities. But unfortunately, that might not be the case. And one of the things that we've seen is that in the past 15 years, there's been times of spiking correlations between risky assets, between the commodities, the stocks, and other risky assets, which make the view of risk different today than it was in the past. The first time in the recession, 2001 to 2003, I think people were kind of taking note, but saying it was a one-time outlier. Then in the global financial crisis, it was the second major time, and it became, oh, you know, commodities aren't really protecting us the way that they should in a crisis time, and the correlation spiked. So at that point, we started seeing shifts in asset allocation strategies that were from security type based, like stocks, bonds, real estate, commodities, over to more of risk type based allocations. So focusing on separating portfolio characteristics like growth or inflation, income, and liquidity. And with that shift came a shift in understanding how commodities work inside of a portfolio context where they fill more of the inflation bucket. But today, again, there might be opportunities in oil. I think it all depends on how long it takes the market to rebalance. Some of the comebacks in oil are spectacular. Last time off the bottom, oil returned over 200% in 2 years. But it seems that the fundamentals aren't in place for commodities today. We're only seeing out of the spectrum of 24 commodities, 4 that are showing shortages. So this little rally just might be a bear market rally. But in order to get the inflation protection, despite the poor commodity performance in the last decade, what we see now is a focus on real assets as a whole. So other assets like property and infrastructure and inflation bonds, and not just the equities of them, but the equities, the fixed income, and the futures, mixing the entire capital structure with the futures gives a low enough correlation and volatility reduction. Actually, by mixing the bonds, you bring the volatility of real assets from about 17.5% down to just over 10%. So that's an enormous reduction in risk, and it's enough to give you the inflation protection that you might be looking for, yet protect against the downside risks and preserve the diversification.
Very good. Thank you. Thank you. John, you guys have some very interesting investments in your portfolio, but
Yes.
If you had to pick a couple that you think have maybe the best outlook next 3 to 5 years, what would you talk about?
Well, Wood Creek's an asset-based investor, and we look at the world through a thematic lens, and we're looking for opportunities where macroeconomic trends or cycles are synchronizing with micro trends within specific sectors of the economy. And so from our view, there's always things in our portfolio that we see as great opportunities. One of them actually has been talked about already. I think in terms of retail in the US, the partialization of retail, Amazon Prime and those trends has really created a lot of stress on logistics networks. There's interesting opportunities if you own the right assets to provide capacity to shippers of goods at certain times of the year and capture attractive economics for that. Another area where we've been active is in the telecom infrastructure sector, cell phone towers and other related mobile infrastructure. Increasingly, because of earnings pressure, public companies who provide mobile services are looking to turn capital expenditures into operating expenditures, which creates a need for an additional balance sheet partner to provide capital to them. So we're always looking for places where there's a need for our investors' capital where we can capture some return for providing that.
Anything in particular where you think you had to guess, looking at your overall portfolio, things that might perform best, say, in the next 3 to 5?
Well, we're generally owning assets for a very long time. We're going in with 10, 15, 20-year investment horizons, so we're not looking out over the short term. I think where we touch the commodities markets is in the agriculture sector, and we're starting to see stress emerge there. We actually exited a lot of our agriculture-based investments in the beginning of 2014, but going through a second, maybe a third year of low commodity prices, we expect to start seeing more stress in farmer balance sheets and opportunities to re-enter that sector at attractive prices.
Okay. Now, Carrie, as an investor, and you look at your portfolio, which we'll talk a little bit more about later in the panel, where do you see the most promise now?
Thanks. So as an asset allocator, what we are looking at now, and every May we do an asset allocation update, and we just did that. So I'm a generalist, so I'll be talking what my team does, but I don't have a product. So what we look at is you've got a portfolio and you're pretty much set with it, and we're going to own equities and we're going to own market returns. And so the question is, how do you hit that sort of spending goal plus give us inflation plus we'd like some growth? And the discussion kind of came around to, with everything being expensive, where do you find that extra sort of margin that will get us to what we need to accomplish? And the sort of feeling was we should move essentially to spread product at some point. So we're going to hold the equities and the bonds, and we already hold some real estate and commodities, and we have that portfolio. So I have all of that. So what we're looking at is the type of thing where the market return over cash isn't going to give you much. So it's a relative value thing, long, short equities, where said simply is you just buy something that's got that's got some value to it, and then that someone can short the really expensive stuff and capture that premium difference between. So that's where we'll probably go. Within our market portfolio, and I apologize for definitions that might sound confusing, we treat active management separately from passive, so I'll call it alpha beta. So in our beta portfolio, last year we added allocation to style premia, which is the factor investing, value, momentum, growth. And this year we're doubling that allocation, so it's still a smallish part of the portfolio, but it goes from about 4 to 8% of the portfolio.
Scott, can you tell us about the private equity?
Sure. So for 23 years, I've been running or helping to run a private equity firm focused on growth buyouts with a reasonably significant credit affiliate. For 11 years before that, I started and ran the alternative investing entity affiliated with the Harvard Management Company. And so we used to, was responsible for real estate, oil and gas, other commodities, venture capital, and buyouts. So some of what I'm going to say will be dated back to those times when there were certain observations we made about when it's most appropriate to flow into some of these asset classes. I would say in general, as I think about what some of the lessons I saw then and think about the environment we're in today, the place of greatest uncertainty is when you're taking asset class bets that are most dependent on broad macroeconomic factors, because I don't think we've seen a period where those macroeconomic factors are as confusing as they are today or where the levels of vulnerability are as high as they are today. And so if you think about things that, like oil and gas, for example, where you can come up with a very compelling argument about why 50 is a reasonable price, and I've heard some of our friends in the Middle East tell me why 30 is a reasonable price and then it may be in that range. And I know there are people on both sides of that. It's one where if you're really focused on that, you want to make a play, the advice I would give is, really look at the boundaries and you're really trying to make a trading strategy within that. The long-term price expectations, given the nature of the supply that supply issues that we see across the world for technological reasons and geopolitical reasons, are such that it's very hard to call longer term, again, where we'll be. And that intersects with another broad macroeconomic issue which affects some of the other asset classes, which is the nature of the uncertainty as to where we are in our economic cycle. Here in the United States, if you look at history, you would say duration, we're late cycle. This is the second longest period of non-recession that we've had post-war after a recessionary recovery. However, if you look at the recovery from trough in any other kind of metric that looks at performance, it's pretty mediocre, and you can argue we're somewhere in the mid-cycle. So again, you have that macroeconomic issue hanging out there, very hard to call. You can make compelling arguments either way. The vulnerabilities that we have relative to where we were 10 or 20 or 30 years ago have been compounded by the globalization of our world. So when China sneezes, as we've seen in the last couple days, you can come up with all sorts of reasons why the US has very little dependence on China for our exports, and we shouldn't really care as much as we do, but yet the stock market reacts in a very volatile way. So looking at the asset classes on an alternative basis, one of the things that you need to think about is where do you shield yourselves from the public market volatility that these macroeconomic factors will cause, because you can pick asset classes where you have the ability to hold through cycles and other disruptions in reasonable ways. And so as I think about all the asset classes, and I'm not going to obviously go into everything because there are better experts on this panel on most of them than me, let me spend a few minutes on the business I have been in for the last now almost 25 years, which is the buyout business and private equity. Over the course of that period, the buyout business in particular has been able to generate rates of return that have far outstripped the equity return from the public markets. So approximately over 20 years, there's about 13, 14% compound rate of return in North American buyouts, and that compares to about 7% for the S&P. And over the 10-year period, it's slightly higher for the buyouts and slightly lower for the S&P. And one of the reasons that that exists is because of the ability to evolve the nature of what we do on the buyout side and be able to pick our times to buy and pick our times to sell. And if we're able to create capital structures that allow us to move through unforeseen economic turmoil, then you have the ability to exit at a time when prices are high and buy at a time, if you're disciplined, when prices are at least somewhat reasonable. I think everyone in our industry today is very mindful of the pricing in the public markets and the multiples that are being paid to buy companies. And either you have to have a very strong thesis of what you can do with that company to justify that double-digit multiple you might be paying for a company with single-digit growth expectations, or you have to be able to create a deal flow that allows you to enter at prices that are much more attractive than what you see from the broad index. And as I look at the business that we're in, most players have been investing very heavily in the ability to do both of those things. So increasing focus, increasing domain expertise allows you to create transaction opportunities that may not be available to everyone. Most of the major firms are able to invest so that they develop their own, if you will, proprietary deal flow. And I know proprietary is a often overused and abused word, but I think you're seeing that happen. And we're all investing and have been investing for quite a long period in the capabilities to help companies improve the operating efficiency of their business in ways that allow them to take market share, to enhance their organic revenue growth, and to position themselves for higher margins. And if you can do those things, then I think you have the ability to continue to generate the outperformance relative to the more passively measured S&P index that we've seen in the last 10 years. So I think our business has gotten much harder. It requires significantly more investment and more proactivity. However, the ability to sustain 500, 600, 700 basis points of outperformance, I believe, will continue to be there.
I think we know where your favorites are then.
I like lots of things.
I want to turn back to John on the question of real estate. Let's just say somehow central banks succeed. We don't fall into a global deflation, and lo and behold, interest rates start actually moving up in the next few years. What does that do for real estate generally? I mean, it's just been so long now since people have even had to seriously contend with this that I think that the knee-jerk response is, well, if interest rates are going up, does real estate as an alternative suddenly become a big problem?
Well, it's a hot debate, certainly. I think real estate generally is perceived as an inflation hedge and ought to offer good value protection in the circumstance where the rising rates reflect inflation. And for many asset classes, that proves true. The devil's in the details, of course. I think the real question is what is driving that hypothetical rise in interest rates in order to determine properly the impact on the asset class. Generally speaking, real estate today, let's focus on the US, supply and demand is more or less in balance in almost every asset class. And that's not typically the circumstance leading into any kind of real estate bubble or difficulty in pricing. So if things are priced to perfection and cap rates expand based on rising interest rates, you will see a little bit of diminution in value, and risk assets ought to reprice in that circumstance. But I don't think we're teed up for anything cataclysmic. When you peel back further layers of the onion, it gets more interesting. Cap rates drive off NOI. NOI is probably not the right metric for long-term holders of real estate. One needs to look at free cash flow, and if you own office, figure out how much of your capital needs to be set aside for leasing commissions and tenant improvements, and will real rents move? And by the way, in most CBDs, over a very extended period of time, they haven't moved. So there can be some allusion to the growth element. Capital preservation probably is intact.
I want to turn to John here at Wood Creek. You're avoiding real estate entirely now within the fund, within the company. Tell me why.
Well, it's, I guess, first, two reasons. First, we're part of a bigger asset management organization, and we have a large sister company that is real estate focused, a company called the Cornerstone. Second, if you look at our investors, which are all very large institutions, they typically have a very well-developed real estate investment program. Many of them actually have in-house real estate investment teams. And we view the opportunity for us in partnering with those clients as bringing something new to their portfolio to help them with diversification and finding returns in other places. So, but I think the question of rising interest rates really cuts across a lot of alternative investment opportunities. And from our perspective, I think you really need to understand what pricing power your assets have in the market, and whether interest rates are rising because we're in a good economic environment, and whether or not you're going to have the opportunity, given the pricing power of your assets, to capture the growth in the economy. So I think it's an important question that investors are thinking about. I think you really need to go down and to the next level or below to really understand the cash flows, as John said, of the assets that you own.
Right. Turning back to Scott on private equity, it does seem as if strategic buyers now are so aggressive that they're pricing a lot of PE firms out of the market. Is that limiting the opportunities you're seeing?
It's actually a great opportunity on the realization side. I think they've been strategics because of the lack of organic growth in many businesses. The ability to do acquisitions and acquire growth, both in terms of just the math of acquiring something, but also the ability to acquire a business that may have better organic growth in your core business, is something that most major corporations are focused on. The ability to execute against that is enhanced dramatically by the very low interest rates. So businesses that have investment grade credit are borrowing between 1.5% and 3%. So in order to have an attractive transaction that's accretive on an EPS basis, you only need to generate a higher single-digit IRR. That clearly does price us out of the market unless we have the ability to, again, come up with something we can do with that company that is different than what that strategic can. And that does sometimes happen. But I would say that more often we're looking to sell into this trend than we are to thinking about how do we compete with the strategic in that way. One of the benefits of buyouts has been the ability to, if you will, unleash the entrepreneurial spirit and activity of management teams, create a different set of incentives and more focus on long-term growth than often occurs as a public company. And that's also true for management teams as they look at being acquired by a large strategic. So they're looking at what do I get now versus what can I do longer term with that asset. And if you can partner with a private equity firm that can help them achieve their aspirations from a growth perspective, then you often can compete with that strategic for certain assets. Obviously, price is going to be important, and so you need to, really have a plan to turn that acquisition into something that may be significantly better than the company that you're acquiring in order to justify the price. But that's where you would need to be on that basis. If you look at overall M&A, private equity has never been much more than 8 to 12% of the global M&A markets. So it's not as if there isn't a big market out there for private equity enough to satisfy most of our investment objectives without really having to go head-to-head with strategics who are, again, interested in using low interest rates and the need for growth to deliver an EPS accretion while achieving a 7, 8, 9% IRR.
On net, has your firm been more a seller or a buyer in the last year?
We have been significantly more seller over the last 3 years than buying. What we have been buying, we're not against auctions. We like to participate. We almost always lose, we found in the last few years. So almost all of our transactions, the last dozen or so, have been, as we call it, off the beaten path. Typically, those are somewhat smaller deals, and that's been a little bit of the trade-off. You can enter at lower multiples than the kind of overall market by a reasonable amount, and you can have something that the resource you bring to bear can have a big impact on the growth rate, but it means you're deploying a lot less capital than you might have a few years ago.
Carrie, I'd like you to describe the decision to move your fund to the risk parity structure a decade ago, what that actually has meant for the fund in terms of performance, and also just talk about the role that alternatives play in the portfolio.
Okay. So when we did this, the process started in 2004, and it's sort of timing is everything. And when I think about how we were able to do it or why we did it, there were 3 key ingredients that we had to have to make that happen. And at the time it was done, risk parity wasn't a term that anyone was using. It was actually based on Bridgewater's all-weather strategy. And WARF is a foundation. We've been in existence for 90 years. Shout out to the University of Wisconsin-Madison. For people who don't know what it is, we're an odd animal. We're actually the tech transfer office for the university, and that's why we started. And so our mission is to move, and it actually is to move the benefits of research to humankind to help them. And then somewhere along the line, they're pretty successful at it, and they started a portfolio. So now we have the $2.6 billion that also supports research. So we still do the patent and licensing of technology. We still move research, even if it doesn't necessarily have a license, and we invest. And so there's sort of a dynamic within WARF that's about innovation and the ability to take risk. And we had a portfolio, and that we had people there for a long time. So the investment director that had been there for 28 years. And we'd had a portfolio that was like an 80-20. We had 80% equities, and frankly, of our 20% fixed income, 5% of that had been at high yield. So we were mostly like an 85-15. So when things were good in equities, we were great. And when things were bad, we were really bad. And the problem was when you started to look out into the distance at the 10-year number, we were pretty mediocre. We were a median performer. We'd had a lot of roller coaster. And then the other piece of the pie that's interesting is that I have no money managers on my investment committee. WARF's board, you just have to be an alumni of the university. And so we end up with a lot of CEO types. And then they know their other CEO friends, and so that's what you end up with this board. So if I put it this way, common sense, and you make this pitch for what we wanted to do, that actually made a lot of sense. So the existing director had left, and they decided to hire someone new, and they were concerned about risk and what was the amount of return we were taking. So as you can imagine, with a portfolio like ours, we were running a vol of about 13, 14% pretty consistently. So the individual they hired came from Fairfax County, and he brought with him the all-weather concept. And the idea was either one of two things he sold them. He said, you could either get the same return for lower risk, or I can give you a better return for higher risk. It ended up playing out that we ended up with significantly lower risk, even as volatility went down in the market overall, but a much higher return. And on the 10-year basis, we are now second, this is my Northern Trust performance, but we're a second quartile performer over the 10-year, second percentile over the 10-year period. So it's worked out very well. We do lever bonds. So you asked how do we use the alternatives. So when I said earlier, we think of the market portfolio completely separate, and that's passively implemented for the most part. And we use futures and derivatives wherever we can. There's lots of risk control. There's lots of stuff that goes on behind the scenes. But once you set aside a significant amount of cash in order to cover any losses you might have, then you just overlay all of that other cash into hedge funds, which have to have a market neutral. So for us, I have to have a market neutral focus to my alternatives. Otherwise, that's another form of leverage. But I have basically about $2.6 billion of market exposures, of which I overlay then another $1.5 billion of hedge fund investments. We've done this for a decade, so as everyone, they might be freaked. We ran this through 2008. It was a very scary time, but everything held up. So the alternatives are there to diversify the portfolio and add that extra layer of return. And really, when we're looking at our active managers, they have to return something over a benchmark. Otherwise, there's no reason to hold a small cap value manager if they're not going to do it. And when you separate that, before the portfolio that we ran was pretty traditional, but when you'd look at, the guy that, our Russell 2000 earned 20%, but your guy earned 19, you're like, that's okay, he still earned 19%. But when you see it as -1, it kind of changes how you look at that, and it isn't as acceptable anymore, especially when I can buy a future for really cheap. So,
I wanted to ask you also, as an investor, to talk about the issues of disclosure and fees on the alt side in particular. I mean, one of the things people assume when they think about alts is lower liquidity and higher costs.
Yeah, so that's a tough one, I think, for everyone. Big picture, fees are, if you know what you're buying and you're happy with what you're getting, that you're actually getting real, to use that overused phrase, alpha, it's the cost of being in the game. So do I like paying some of those fees? No, not particularly. But at the end of the day, if I can get that, and we're targeting in the active management portfolio, the 200 basis points overlaid on my portfolio, if I can get that on a net basis, and we've been able to do that by very carefully selecting the managers, and the incentive structure, maybe they're winning slightly more than I'm winning, but if we both win, that's what you're looking for. And so we hold a pretty concentrated portfolio. It's mostly all hedge funds at this point. There's a 10 percent allocation to private equity venture capital. We tend to be more venture capital weighted, as you might expect. But on the fee side, it's knowing that you're getting what you're paying for, and we pay very close attention to that. As I said, we have a very small portfolio. And if you can negotiate it, you try to. So we're in Bridgewater's all pure alpha fund. We can't negotiate anything there. But some of the smaller hedge funds, one of my hedge fund person was just able to negotiate a 0% fee, actually, and a 30% incentive if they hit an 8% hurdle, and they were willing to do that. So, it's about trust and making sure everyone's incentives are aligned. They feel that confident about what they could do that they were willing to do that. We ran our numbers and said, if you can do this, this is great.
Interesting.
Can I just chime in
Please.
there, Tom? I think there are two parts to your question. On the fee side, I'm sure we'd all agree it's not a static world. It's an evolving world, and directionally, investors ought to and are demanding more for less, generalizing to the point of truism. But we're working hard on curating products that are structured differently than typical lockup commingled funds, trying to find ways to give investors liquidity. As a listed REIT with an embedded asset manager, we have some abilities to do that perhaps differently than other people. And I think investors very much ought to focus on net, not merely gross returns. That's all they can eat. The liquidity side is an interesting attribute as well, and it struck me that by tying that to the fees, you're trading one against the other. Part of the reason that we favor a heavy allocation to alternatives is that we think the liquidity premium is often mispriced in many supposedly liquid asset classes. And I suppose it goes without saying that liquidity is at its most prevalent when you need it the least. We've also found that investments like single-family homes, for example, which I mentioned earlier, we could monetize that entire portfolio in a few weeks' time. Is that an illiquid asset? Of course, technically, but it's not as if you can just dial up your broker and say, give me the alternatives ETF. That doesn't exist. So there's an interesting juxtaposition, and I think not a static one.
Interesting. John, I wanted to talk with you about the liquidity issue.
Yeah, it's an important topic. It's something we spend a lot of time talking to investors about. I actually agree that there's generally some mispricing that happens, and I think our investor base is all institutional investors, large institutions, and we work with them on a direct fund of one basis and build bespoke portfolios for them. But when you sit across the table from them, what you understand is liquidity is one of their best tools. It's one of their greatest advantages as an investor, to be able to go and have a real 10, 15, 20, 25-year time horizon. It's a very competitive world that institutional investors are trying to place capital into, and so that's one of the best levers they have in deploying their capital, is being able to take that risk. They need to understand exactly what that means in the context of each investment, but I think it's an important lever for them. Secondarily, we're very focused on assets that are cash flowing and creating some liquidity along the life of an investment for investors. And
So an income stream.
An income stream, and I think that's an important risk management tool for investors. It certainly is for us. Not only does it reduce your total liquidity risk, but it reduces your vintage risk as well. And when you start thinking about investing in a portfolio of private investments that have some liquidity windows.
I wanted to ask you about one area that you guys are invested in, which is intellectual property. How do those investments typically work, and what kind of liquidity do you have there?
So at any time, 30 to 40% of our portfolio might be in intellectual property-based investments. Those could be copyrights, things like catalogs of music rights or film and television rights. They could be in the intellectual property associated with pharmaceutical assets. I think on a direct investing basis, it's an area where not a lot of capital has gone directly from institutional investors. I think from a macro perspective, when we think about operating in a knowledge economy, our view is that intellectual property is the core infrastructure that makes our economy work today, and so there's great value to be captured as an owner of it. The investments work the way that any other investment would work. It's because it's a diverse asset base, it gives you a lot of opportunity to diversify within it itself. So some assets have very long legal lives, copyrights, for example. They may have shorter useful lives, Some assets like patents have a very defined legal life, and so you can use that difference in expected timing of cash flows and life of assets to ladder your portfolio of cash flows and build what we think are very interesting risk-adjusted returns.
Carrie, is that something you guys have invested in at all, any kind of intellectual property alts?
No, we have looked at it. People come to us. We have a pretty big portfolio just by
Naturally.
the nature of what
Yeah.
we do,
Right.
that we haven't looked to diversify that away.
I want to turn back to Jody here on the question of commodities because there's nothing esoteric about those, right? And I guess that's part of the problem now is there's just so much of so much, you know, the old line about commodities I learned as a young journalist was, you know, you rent them, you don't own them, because there's always a cycle here. I think the question a lot of people have now, they look at the commodity bounce this year, they look at what you pointed out, which is that equities have outperformed commodities for 8 years. But I think one of the problems is nobody can quite figure out where China is in this equation, right? And is that really the biggest wild card of all in terms of demand, in terms of stockpiles they already have? Does China just change everything in terms of looking at commodities and wondering how commodities will do over the next 5 to 10 years?
China changes everything, not just for commodities, but for pretty much investments in every asset class around the world. And when we go back to some of the things that we've talked about here, correlations with the risk parity, we talk about liquidity. Risk parity looks at correlations. The problem is, who would have guessed that it was going to be the Chinese stock market volatility that would be the thing that spiked correlations in the first quarter? If I asked all of the investors that I talked to in 2010, what's the next one factor that's going to drive all correlations of risky assets to spike together? I don't think I would have heard too many answers. Chinese stock market volatility. So I think that what's important is, first, on the liquidity side, a dollar is worth more than a dollar when you need it. In the global financial crisis, when everything froze and it was difficult to get your assets out of things that were traditionally pretty liquid, your bonds, your stocks, turning to something like commodities was an area of liquidity. So I think that commodities have been viewed a little bit differently in terms of characteristics, not just the performance characteristics, but the risk characteristics. Like I mentioned, those buckets. There's the growth, inflation, income, and liquidity. It does serve an inflation bucket, but also a liquidity bucket. So there's that. And then if you look at the macroeconomic factors, you can look at the traditional macroeconomic factors. And things like rising interest rates are typically good for commodities. You collect the return on the collateral. It also increases the storage costs, which price the futures contracts higher. So that's positive for commodities. Inflation is positive for commodities. In fact, the more energy you have, the better in an inflationary environment. But I think that the strongest macroeconomic factor right now for commodities is a weak dollar. A weak dollar is more powerful to drive commodities pricing up than a strong dollar hurts them. So there's been focus on the dollar as a macroeconomic factor, and as the dollar comes down, that could be a very powerful catalyst for commodities. But it's important to look inside the spectrum. You can't just say all commodities are the same. While Chinese demand on aggregate can have an impact across the board, energy doesn't move the same as agriculture, doesn't move the same as metals. For gold, we can't figure out what drives gold. Gold, you need some kind of combination of high interest rates, high inflation, a weak dollar, and we saw that back in the late 70s, early 80s, and then gold did nothing for 20 years. And at the invention of the gold physically backed ETF, when physical gold was coming off the market, we saw a bull run in gold. I didn't see any other macroeconomic factor that went straight up like gold. So
For 11 years.
For 11 years straight. And then it dropped 30% in 2013 and didn't bounce back. So there goes gold as a safe haven. Where do you turn for gold? But then, funny enough, people forget. And in the first quarter of this year, people turned to gold when they saw the stocks crashing and the commodities crashing.
And the dollar weakening.
The dollar weakening. So it's kind of hard to figure out what drives gold. But for the other ones, energy, you can look at things like the OPEC supply, which was much more powerful when they started supplying in the summer of 2014 to lower the price. Then they're able to rise the price back up. They're not really able to act as the cartel that they hoped to because of the high inventories in the US that are dominated by a lot of different companies. So until the US inventories come down, the decisions, if, when, how they come down. I mean, if eventually they probably will, because the suppliers will pull back naturally. Supplying into an oversupplied market at some point doesn't make a ton of sense. So we've already seen some mergers, acquisitions, bankruptcies, pullback of supply, even some exports starting to come online. So when they do, at some point, that's when OPEC's policy will matter more. And unfortunately, by that time, China, the customer that everybody was after, is a different customer because they've already filled up a lot of their strategic petroleum reserves. And so the market share that Saudi and OPEC are working to maintain, it's a market share of what? Because if China is not really buying as much as everybody hoped, then does it matter?
Right.
That's a question. And then, something like agriculture, the weather matters so much for agriculture. The El Nino, I know we've seen a lot here in this conference about climate change and responsible investing, but even though those long-term things are idealistic, I always get asked on a short-term basis, where in commodities might there be return opportunity? And agriculture and livestock are one of the places because of the weather volatility that destroys the supply. And it's really hard for investors to look past that and say, okay, well, I'll give up on those short-term returns in order to maintain a socially responsible portfolio.
That's right.
Tom,
yes.
Can I ask a question of Jody?
Please.
Because we have, as you said, we hold commodities in the bucket. I'm curious what you see investors, how you see them accessing it, what they're doing, because it's probably been my most problematic allocation, and we've come at it and we've re-implemented it a lot of different ways. But it's still the most difficult for people to actually, there's a big debate as to whether there really is a return there. And so yes, it definitely diversifies, but it's kind of been brutal to hold for the last 2 years. So I'm curious what you see in whether investors really are embracing it or not.
It's been a challenging space, I think, not just in the past 2 years, but in the past 10 years. We saw 2 major oil drawdowns, which drove a lot of the sector. But one, what's the main way that they access it? Swaps from institutional investors are the main way that they access it. But we've seen a development in strategies. Today, we have over 5,000 commodity indices that we calculate a day. So when you talk about passive versus active, where's that line? Wherever we can take what we know from the active space and put it into a methodology that's transparent, rules-based, implementable, then we try to put that into the passive space. And what we result with is strategies that pick optimal contracts that might avoid some of the contango. Or you can go long short, leveraged, inverse. There's all of these different types. So we do see the new innovations in going long short and indexing coming to be more popular in the institutional space. And again, to think about how do you get at it and how do you get at the commodities, it depends if you're the kind that is looking for the diversification and inflation or if you're taking a bet. And that goes into like a core and satellite sort of thing. It's the passive active thing. And on the bet taking, we've seen tons of activity last year. People buying more energy because they thought that it was a cheap price. They want to go for the returns. And from the inflation perspective, trying to get just a little tiny allocation for a big, giant inflation protection, nothing gives you a better inflation beta than energy, like the S&P GSCI. That's world production weighted, 70% energy has a 15 inflation beta. So for every 1% of inflation move on CPI, you get a 15% return. If you go something more equally weighted, like Dow Jones commodity, you have an inflation beta of 10. These are enormous inflation protections, so everybody loves that, but they just hate the returns of commodities. So, that's where the diversification into the real assets is coming in, to try to get some of that inflation beta, but not take the huge downside risk.
I wanted to ask everybody, if we look at retail investors, Morningstar counts right now about 157 alternative asset mutual funds with about 55 billion total in them. In 2007, there were just 25 funds with 6 billion. So clearly there's a retail appetite there for alt. Whether or not retail always knows what it's doing, or its advisors know what they're doing. But I wondered, as we look out over the next 3 to 5 or even 10 years, do you think there will be a greater push for retail products in the alt universe that can make money for the sponsors, but also can make money for retail? I mean, is that more of a possibility here? I want to start with you, John, in terms of a lot of things you guys look at, which are some very esoteric things. Is there because we know the demand is going to be there, especially if the equity returns turn out to be as poor as people believe. There's going to be a lot of retail money looking for better returns in something. When you say alternative, it sounds sexy to people. They'd like to be in it. A lot of them don't understand it.
Yeah, so I guess first I think we like to think that what we do is actually not that esoteric. And so I actually think for a lot of the investments we have, they would resonate with retail investors because they could understand very clearly, oh, well, you own music catalog XYZ. I understand how it makes money. It gets played on the radio. It gets played, I stream it on Spotify. It's much simpler to understand than how a long-short equity hedge fund manager might actually be creating value. So I do think there's an opportunity for alternatives. I mean, taking a step back, I think the defined contribution system in the country is broken. I don't think it serves retail investors very well. And so there's a lot of opportunity for the asset management industry to come up with better solutions, better products to help investors achieve their objectives, retail investors achieve their objectives. And I think alternatives need to be part of that from a diversification standpoint.
Right.
Yeah, I would say that there is definitely demand there, particularly as you look at places to outperform. It's not just large pension plans that need the excess performance to meet their actuarial requirements that look at alternatives in a positive way, but I think individuals in a world of almost 0% fixed income returns for most individuals, right, who cannot deploy complex strategies to garner that extra 100 or 200 bips of rate return. They're going to be looking for places to go. Now, the danger is a lot of the conventional wisdoms of investing, I think, are questionable as we go forward, and I think people on the panel have talked about it. I would say all the correlations, we have always been surprised when the correlations don't work in the way we thought they would work during times of crisis. And I've seen that now over the last 30 years happen numerous times. We talk about inflation, and I think that's something to talk about. I think the financial market providers were all really good at coming up with new technologies that allow people to access certain securities, I guess is the best way to do it, that will do something for them. And what they're doing for them is something that's based on those conventional wisdoms. Oftentimes underneath, as we saw in 2006, 7, and 8, there is a level of complexity that very few people understand that may encompass natures of leverage or, again, the certain beliefs of how the world works that turn out not to be true. So, inflation protection is great in certain asset classes, so commodities historically, and it has been negatively correlated to the S&P historically. However, the nature of the inflation often indicates an overheated economy because of overheated demand, not necessarily overheated because of this enormous supply of currency that has been pumped in. Right. So if you take what's going on in China, I've always thought the Chinese government has been incredibly artful at managing through their economy. But when you look at the amount of liquidity that has been pumped in and the artificial bubbles that have been created, that's not because there's real demand there. And so normally you would say, well, that should cause demand for commodities to go up. But as you point out, we're not seeing that, and we're not seeing it for good reasons. So as retail investors look at things that they might be able to buy, if those things were created with a certain set of assumptions about how the world correlates and works, it could be a little dangerous. And I think that's one thing to be mindful of.
Interesting. Let's get John, just Colony and the retail investor. Can you see Colony embracing that audience more in the next 10 years?
Well, I suppose we have to. We've ourselves transformed into a listed REIT with an embedded alternative asset manager, in part to be able to attract capital. But I think Scott's warnings are really well taken. And a fundamentally illiquid asset baked into a daily mark, daily liquidity product has got to put up warning signs. Look at the high yield sector where ETFs and mutual funds have become big investors. How does that work when there's flows out? Substantially. That worries us quite a lot. So I think we need to do a better job of packaging appropriate product. There's lots of our institutional and other investors that don't want daily marks. They absolutely abhor them. But in our space, you see non-traded REITs providing the notion of liquidity to retail investors, aggregating enormous investable funds. And the lack of transparency, the lack of homogenization of reporting, those are also warning signs. So the 401k industry, to John's cogent point, I think needs to do a better job of finding a way to accommodate alternatives. Today, if our math is right, the 100 largest alternative asset managers in the world globally represent only about $1 trillion of AUM. Institutional allocation to alternatives itself is many multiples of that.
Right.
So there's a mismatch right now. It's going to take a generational change.
Interesting. I think from the standpoint of all of your businesses, if only we could all follow Buffett's advice, which is never buy anything that you wouldn't be happy just not looking at the price again for 10 years. Imagine that level of trust on the part of your investors, right? Well, I want to thank you all for coming today. I hope we enlighten you a little bit about alternatives. I want to thank the panel members very much for coming.